$33 trillion. Say that number out loud. $33 trillion. That is not the national debt of some collapsed banana republic. That is the number sitting on the official US debt clock right now, this second, as you're watching this video. And as of 72 hours ago, something changed inside that number that every single financial analyst on television is completely ignoring. The United States Treasury has officially crossed a threshold that their own internal models said would trigger a debt spiral. Not in 5 years, not in 10. Their own documents say the window to correct this is 90 days. 90 days. After that, the automatic mechanisms that have kept this country's finances from imploding, the emergency levers, the foreign buyer backstops, the quiet Fed interventions, all of them stop working at the same time. In the first place, you will feel it, is not in the stock market. It is not in some abstract economic report. It is in your mortgage payment, your grocery bill, and the balance of the retirement account you have spent your entire working life building. Stay with me, because what I am about to show you is not a prediction. It is math, and math does not care about your politics. Before we go any further, if you are new here, subscribe right now and turn on the notification bell. We track these debt markets every single day, and the next update is going to come fast. You do not want to miss it. And drop a comment below. Do you think the US will hit a debt ceiling crisis before the end of the year? Type yes or no right now. I want to see what this community actually believes. To understand what just happened, you need a 60-second history lesson that no one in school ever gave you. For the last 80 years, the United States operated the greatest financial privilege ever granted to any nation in history. Because the dollar was the world's reserve currency, every country on earth needed to hold US dollars. And to earn a return on those dollars, they bought US Treasury bonds. This created an almost bottomless demand for American debt. The US government could borrow unlimited money at artificially low interest rates because foreign nations were standing in line to lend it to them. China bought it, Japan bought it, Saudi Arabia recycled its oil revenue into it. The entire world was essentially co-signing the American government's credit card. That era is over. In the last 18 months, foreign holdings of US Treasuries have dropped at the fastest rate since records began. China has been selling. Japan has become a net seller. The Middle East sovereign wealth funds are quietly diversifying. And here is the catastrophic part. They are not selling because they are panicking. They are selling because they have made a calm, strategic, long-term decision that the United States is no longer a reliable borrower. They looked at $33 trillion in debt, a government running a $2 trillion annual deficit, an interest expense that has now surpassed the entire U.S. defense budget. And they concluded what any rational lender concludes when they see those numbers. They stopped lending. The United States is now spending more money on interest payments on its debt than it spends on the entire U.S. military. That number crossed over in the last fiscal quarter, and Washington has said almost nothing about it. So here is exactly how this plays out. Follow this chain carefully because each link is happening right now, in real time. The US government needs to borrow approximately $2 billion every single day just to keep the government operational. That is not to invest in infrastructure or pay down old debt. That is just to keep the lights on in Washington. To borrow that money, the Treasury holds debt auctions. They put bonds up for sale and wait for buyers. For decades, those auctions were oversubscribed, more buyers than bonds. The US could name its price. That dynamic has now flipped. In the last 4 Treasury auctions, the demand has come in below expectation. The bids to cover ratio, the measure of how many buyers show up per bond available, has been falling steadily. When that ratio drops below a critical level, the Treasury has to offer higher interest rates to attract buyers. Higher rates on new bonds means higher rates across the entire economy. Your mortgage tracks the 10-year Treasury yield. Your car loan tracks it. Your credit card APR tracks it. Every time the government has to pay more to borrow, so do you. But here is where the 90-day clock enters the equation. The United States has approximately $9 trillion in debt that matures, that must be rolled over and refinanced, within the next 12 months. $9 trillion. When that debt was issued, interest rates were near zero. The government was paying 1-2% in annual interest. Now, to refinance that same debt, they have to pay 5, 6, potentially 7%. On $9 trillion, the difference between a 2% rate and a 6% rate is $360 billion in additional annual interest expense. Every single year, automatically, permanently, compounding. And the 90-day window refers to the largest single tranche of that refinancing, roughly $3 trillion that hits the market in the next quarter. If the auction demand is not there, if the foreign buyers do not show up, the Federal Reserve will face an impossible choice. Let the auction fail, which would be the first U.S. debt default event in modern history. Or step in and print the money to buy the bonds themselves, which would trigger the inflation spike that finally breaks the American consumer. There is no third option. There is no soft landing. There's no clever policy trick that makes $9 trillion in refinancing disappear. The Federal Reserve cannot cut interest rates to ease this pressure because inflation is still running above target. And they cannot raise rates to fight inflation without making the refinancing crisis worse. They are completely trapped. Both doors are locked. Now, what the mainstream financial media is not telling you is that there are 3 additional accelerants sitting directly on top of this fire. The first one is the derivatives market. Sitting underneath the visible bond market is a shadow market of interest rate derivatives worth an estimated $600 trillion. Yes, $600 trillion. These are contracts that pay out or collapse based on the direction of interest rates. When interest rates move unexpectedly, and a failed Treasury auction would be the single most unexpected interest rate event in 50 years, the losses in the derivatives market trigger margin calls. Margin calls trigger forced selling. Forced selling triggers more margin calls. You get a cascade that the 2008 financial crisis was only a preview of. The second accelerant is the commercial real estate wall. There is approximately $1.5 trillion in commercial real estate loans, office buildings, retail centers, apartment complexes, that must be refinanced in the next 18 months. If these loans were written when rates were near zero, refinancing them at current rates makes the properties mathematically insolvent. The banks holding these loans are already sitting on hundreds of billions of dollars in unrealized losses. A spike in Treasury yields caused by failed auctions would push those unrealized losses into realized losses, triggering bank failures that make Silicon Valley Bank look like a rounding error. The third accelerant is the most dangerous and the least discussed: the dollar's reserve status itself. Every failed auction, every money printing intervention, every inflation spike sends a signal to the 70-plus countries that are currently in active discussions about reducing their dollar reserves. Each one of those countries exiting the dollar system means fewer buyers at the next auction, which means higher rates, which means the next auction is harder to fill. It is a self-reinforcing exit. Once it begins in earnest, there is no mechanism to reverse it. China knows this. Russia knows this. The BRICS nations have built an entire parallel financial architecture specifically for this moment. They are not scrambling. They have been preparing for years while Washington assured everyone the dollar was untouchable. I want you to stop thinking about trillions for a moment and think about your own kitchen table. If the $3 trillion refinancing auction goes badly this quarter, and the probability of a stress event is now being quietly priced into the bond market, here's what that means for you personally. If you have a mortgage or you're trying to buy a home, mortgage rates do not go to 7%. They go to 9%, maybe 10%. The monthly payment on a $400,000 home at 10% interest is over $3,500. At that rate, the housing market does not slow down. It stops. If you have a 401k, understand that a spike in Treasury yields crashes bond prices immediately. The bond portion of your retirement portfolio, the part that was supposed to be safe, loses value in real time as yields rise. And when bond portfolios at pension funds and insurance companies take losses, they are forced to sell stocks to cover obligations. Your equity portfolio drops simultaneously. If you have savings in a bank account, understand that the FDIC insures deposits up to $250,000. But the FDIC's own reserve fund is a fraction of the total deposits in the American banking system. If a cascade of bank failures begins, the government's ability to backstop every depositor simultaneously requires printing money on a scale that destroys the purchasing power of those very dollars you are trying to protect. You pay the price 3 ways: higher borrowing costs, lower asset values, weaker purchasing power, all at the same time. This is not a theory. This is the mechanical output of the math when a government with $33 trillion in debt loses its pool of willing foreign lenders. They spent the money, you're holding the bill. The most dangerous 4 words in personal finance right now are: someone else will fix it. No one is coming to fix this. The people who created this problem are still in charge of it. So what do you do with this information? The first thing you do is stop pretending that your financial advisor's standard playbook applies to a sovereign debt crisis. 60% stocks, 40% bonds worked for 40 years because bonds were safe. Bonds are no longer safe. They are the source of the instability. The second thing you do is think about the difference between assets that are someone else's liability and assets that simply exist. A treasury bond is a promise from a government that is mathematically unable to keep all of its promises. A piece of land, a commodity, a physical store of value, these things do not have a counterparty who can default on them. The third thing you do is compress your time frame. Most people operate on the assumption that they have years to adjust their financial position. The 90-day clock on this refinancing wall means that assumption may be the most expensive mistake you ever make. I'm not telling you to panic. Panic is a decision that costs you money. I'm telling you to move, deliberately, intelligently, now. The window that exists today to reposition before this repricing hits the broader economy is a gift. It will not stay open. The last people to recognize what is happening are always the ones who pay the highest price for having waited. The debt clock hit 33 trillion. The foreign buyers are gone. The refinancing wall is 90 days out. The Federal Reserve is trapped. That is not a prediction. Every single one of those statements is verifiable in public data right now. The only variable left is which side of this event you're standing on when it hits. If this video opened your eyes to something your bank and your broker are not telling you, share it. Not for me, for the people in your life whose savings are sitting in exactly the wrong place right now. Send it to them. It may be the most important financial conversation they have this year. Subscribe and hit the bell. We are going to be tracking this refinancing window in real time as it develops over the next 90 days. Every update, every data point, every signal, you will get it first. Because the storm is not coming. It is already here.